Thinking about this. Does it pop up to show you guys that it's recording?
Yes.
Okay, perfect. All right. Well, welcome guys to our September Doors, Deals, and Dollar series. Today is a special series that by popular demand, we are inviting some specialists here back with us because, a lot of folks are interested about learning more about the 1031 exchange and also options about the DST as well, the strategies that they can implement for tax deferral purposes. And so, without further ado, I'm going to get started, but I want to give you guys some little housekeeping reminders. Keep your mics on mute in case but if you have questions, please feel free to raise your hand or put it into the chat, and we're more than happy to address it as we go. We want this to be very engaging, so at any point you have questions, feel free to, again, raise your hand, pop it in the chat, and either John or Chris will be able to share or respond to your questions if time permits. But at the end, we also still preserve at least about 10-15 minutes of a Q&A so that to make sure that you guys have the time to ask the questions. And if we run out of time, don't worry, we will provide you Chris and John's contact information so you can follow up with them as well to have a one-off. And with that, I would like to introduce myself. You guys know I am Tiffany Lunt. I am the co-host today. I am the founder and managing principal at Lux Equity Capital. What I do is I'm a multifamily syndicator, and what that means is I essentially just help pool funds together with people who wants to invest in larger apartment buildings together. Without my day job, I do the co-hosting with Carla Cordovis, and I'm going to go ahead and punt this over to Carla, and then Carla will then open up for Chris and John.
Yeah, I think that our day jobs we do a lot more. But we need
Oversimplified
to
it.
keep it short. But we need to keep it short. But hi everyone. Thank you for coming in and taking that time out of your day to listen to this very important conversation. We hope that it is beneficial for everyone here that wants to get a little bit more insights about these strategies. My name is Carla. I'm the founder and managing member of Goldman Capital. It is a real estate investment company, and we help small business owners and tech leaders as well, because I have a tech background, to invest in real estate, whether that is through multifamily syndication or other means. I'm very excited to talk about this topic because it's a topic that is extremely important to all of us, whether you're an active investor, whether you're a passive investor. So please, without further ado, I'm passing it on to Chris and John.
Thank you so much, Carla. I appreciate that. First slide, I guess. Let's go ahead and do that.
We're going straight into the slides. As you know, just so you guys know, Chris is the expert from exchange resources, and he is going to be going over our 1031 exchange. Okay, so let me go ahead and
perfect
share screen. All right, can you guys see
my screen? There I am.
Perfect. Handsome guy.
Oh, thank you. Thank you so much. I try. So before we get started, just wanted to let everyone know that we are not CPAs, tax advisors, or legal advisors. So we do recommend that before doing a 1031 exchange, that everyone seeks the advice and counsel of these professionals, because everybody's tax situation is different. And, we want to make sure that the 1031 exchange is definitely right for you. Before we start, so that everybody knows, a 1031 exchange is when an investor sells their investment property. Let's say they bought the property 20 years ago, and now the property is worth $2 million, right? 20 years ago, $2 million. If they were to sell that property without doing a 1031 exchange, there's a huge tax consequence of about 30 to 40% in taxes that they're liable to pay if they don't do a 1031 tax deferred exchange. So doing the 1031 exchange allows that investor to roll all those gains over into other properties so that they can have a 100% buying power, and they can defer all those capital gains taxes. Some of the myths I want to go over really quick is some people seem to think it's just for the wealthy, when really and truly it's not. It's for the mom and pops who are just starting their investing and have maybe one or two investment properties that they want to do a 1031 exchange. The 1031 exchange code has been around since 1921, and it's not a loophole. It has created wealth for many investors all throughout the years. So that is definitely one of the most powerful tools still to create wealth and a legacy for your family. Another myth is some investors seem to think, well, I want to sell my primary residence and I want to purchase an investment property. Well, primary residences don't qualify. They qualify with a 121 tax exclusion, which is a different tax code, where if you're single, the first $250,000 is tax-free, and you can sell it if you've owned the property for 2 out of the 5 years. If you're married, it's $500,000, but they do not qualify for a 1031 exchange. And another myth is that people seem to think that when they involve themselves with a qualified intermediary, which is what we are, in the middle of that transaction, if they're having problems with that qualified intermediary, that they can switch to another qualified intermediary, which is not the case. The IRS is very strict on this, is that if they do start their exchange with that QI, they have to stay with that QI until the end. They can't switch. And that's why it's good for investors to do their due diligence and make sure that they're with a reputable company that has a history of success in helping many investors. So who are we? Who is Exchange Resources? We're one of the largest independent qualified intermediaries in the nation. We do exchanges in every state. We've been in business for over 26 years and have done over 60,000 tax-deferred exchanges in the last 26 years. And as a qualified intermediary, what we do is we hold the funds in trust for the investor. So when the relinquished property, the rental property sells, that $2 million is not wired or given to the investor. It's sent to Exchange Resources, where we hold those funds in trust until they're able to identify the replacement property and close on that replacement property. We also open up segregated client trust accounts. We never, ever commingle our clients' funds. We always open a segregated client trust account. And also, more importantly, we've increased our fidelity bond insurance to $10 million so that our clients feel safe knowing that their money is not going to disappear. And we also have the appropriate errors and omissions coverage. So we're very strong when it comes to our insurances, and we have a reputation of being a very successful exchange company. Next slide. So these are all the benefits of doing a 1031 tax-deferred exchange. The number one benefit is obviously the deferral of capital gains taxes. We had a client who purchased a property in La Jolla about 15 years ago. He was going to have a $2 million gain, and he's in dialysis and he's elderly, and he didn't want to deal with doing a 1031 exchange. As a matter of fact, he didn't know what his options were. He was just going to sell the property and pay the 30 to 40% in taxes, which is about $600,000 to $800,000. And that's the client that John and I are working with right now. But once they found out what the opportunities were and where they can roll that money into, they changed their mind. And now they're rolling it into a DST, which is a Delaware Statutory Trust, which John Grady is going to go over later on in the slides. It creates wealth for many people who don't want to deal with running and managing properties anymore. It's a great way to reinvest those funds into other properties that give them the passive income without the headaches of management. Increased cash flow, diversifying. Many investors in San Diego who have had a significant gain on their properties can sell their $2 million property here in San Diego and then buy 2, 3, or 4 properties in other states, increasing their cash flow. Plus, it's also great for estate planning. When in our industry, there's a saying that goes, swap until you drop. There's an unlimited amount of exchanges that you can do. But once these investors are actually done swapping properties and exchanging properties, the day they pass away, the heirs receive all the properties in a step up in basis, and all those taxes are forgiven, which is definitely a great benefit. So it's great for estate planning and also providing a legacy to your families. All right, next slide. So let's talk about 2 types of investors. All right, investor A and investor B. For many investors who don't really know about 1031 exchanges, some investors just don't want to bother with the hassle of complying with the rules and regulations of the 1031. So they just wind up selling it, selling the property without doing a 1031 exchange. And for a lot of investors, sometimes they don't know that a 1031 exchange is an option. So with investor A who didn't do a 1031 exchange or who's not going to do a 1031 exchange, they're liable for the federal capital gains tax of up to 20%. You have the California ordinary income tax of about 13.3%. And obviously, there's the depreciation recapture tax of 25%. So if you've depreciated your property $100,000 over the past 5 years, 25% of that $100,000 or $25,000 automatically is taken off right off the top of those taxes. And as you know, the depreciation is a great benefit because it reduces the taxable income on the income properties as you own the properties and operate the properties. And also there's the Medicare surtax of 3.8%. So there's a lot of taxes. It's a lot. It's about 30 to 40%. And on a $1 million gain on this specific example, it's about $300,000 to $400,000. So investor B decided to do their due diligence, talk to their CPA, planned for exchanging their property for more properties, and did their due diligence on 1031 tax deferred exchanges and was able to keep 100% of their gain and roll it over into another property. So your buying power increases to 100% if you're able to buy equal to or greater in value than what you're selling for. So just a great benefit, and it's still here. And with the big, beautiful bill that just passed, we're still good for the next 4 years. Nothing is jeopardizing the 1031 industry. And as you know, we're always on the chopping block every year because the federal government wants their taxes now. But with the big, beautiful bill, we're smooth sailing for the next 4 years. There's no issues. And Michael can probably interject later and talk to you a little bit more about, you know, what the outlook is for that. So any questions on this so far? All right, next slide. So what I want everyone to understand here in this slide is what our responsibility is. So if you can click one more, just click on, there you go. So Exchange Resources, our responsibility is to facilitate the 1031 exchange and hold the funds in trust for the investor. So this is the 1031 exchange process. It's actually escrow, right? Because when the agent lists the property, they identify who the qualified intermediary is, an offer is accepted, escrow is open, and at that point, that is when the documents for the 1031 exchange needs to be fully executed before the close of escrow. So as soon as it closes escrow, the relinquished property closes escrow, 2 things are triggered. The proceeds are wired to the QI, the qualified intermediary, the accommodator. It's synonymous. So proceeds are wired into Exchange Resources, and it also triggers, as you can see there, the 45 days to identify the replacement property, okay? In that period, they identify the replacement property. They have to submit a list of those properties by midnight of the 45th day. And as soon as they identify the property and say, hey, Chris, we've identified 1 out of the 3. Let's go ahead and open escrow on that property. At that point, we send the earnest money deposit to open escrow on that replacement property. And then the inspections, due diligence, and contingencies are removed. And the remaining purchase funds are sent to the closing agent. And as you can see here, it must close within 180 calendar days. Any funds remaining goes back to Exchange Resources to account for it, and it goes back to the investor who will pay boot on that cash. And I'll go over that later. But that's basically the process. But our goal is to make sure that the investor does not touch the money because it'll be constructive receipt and they're going to be taxed. Okay, next slide.
Would this be a good opportunity to do the first poll?
Yes, let's do that. Oh, and before I forget, just so everybody knows, we're actually doing a $25 gift card at the end of this presentation. So the more questions that you ask and the more answers you respond to, the greater the chances are for you to win that $25 gift card, which Tiffany and Kara is going to go ahead and measure and make sure that they take into account.
Awesome. Thank you. So I'm going to launch this first question so
Okay.
that hopefully you guys were paying attention because I think he did drop this information here. So first question, true or false, extensions are automatically allowed if you miss the 45-day identification deadline in a 1031 exchange.
Mm.
Give it a couple seconds here. All right. Well, I guess we can't fool these guys. Every everybody answered correctly. It's false.
Okay. And again, when it comes to the extensions, they're very strict. Even if the president has declared a certain location a natural disaster, the investor still has to contact their CPA and contact the federal government, the IRS, to determine if they're qualified for an extension, especially since we've had the floods, the fires, COVID. You have to be an affected taxpayer, and the burden is on you to prove that you actually qualify. All right. Next slide. So what I did was I sent Tiffany a cheat sheet on the 1031 tax deferred exchange. These are the basic rules that you need to know. This is all you really need to know. I'm going to go over it really quickly. In order for the 1031 exchange to be successful, you have to buy like-kind property, investment for investment, real estate for real estate, rental for rental. Primary residents, again, do not qualify unless you turn them into a rental property and you've seasoned it conservatively for 2 years. Now, there's nothing in the 1031 exchange rule that indicates how long you have to own that investment property, but we conservatively recommend that you hold it for 2 years. So like kind doesn't mean selling a 3-bedroom, 2-bath home and then purchasing a 3-bedroom, 2-bath home. Like kind can refer to buying commercial property, industrial property. It can be vacant homes. Sorry, vacant land, and also Delaware statutory trusts. That's also a like-kind property, which John Grady is going to go over. You have to buy equal to or greater in value than your net sales price. So people often ask me, Chris, what is the net sales price? What is that target price that you need to purchase in order for it to be fully tax deferred? And let's say the list price is 1.6 million and it's $100,000 in closing costs, taking into account the commissions, transfer fees, escrow fees, and whatnot. So 1.6 million minus 100,000 is $1.5 million. So the investor needs to purchase $1.5 million in order for that exchange to be fully tax deferred. And they have to move over all the proceeds and also the loan. So if that $1.5 million is $1 million of gain, and there's a $500,000 loan, that $1 million of gain has to be rolled over into the next property. And that $500,000 also has to be rolled over into the next property. So they can either get a new loan or replace that loan with their own funds or get seller carryback financing. But think of that $500,000 as cash. It just belongs to somebody else. It belongs to the bank. So all that cash needs to be moved over. And some people say, Chris, is it all or nothing? Do I have to buy up in value? What if I can't find a property for 1.5 million that I like, and I can only find something for 1.4? Well, you can do that. The difference is $100,000, and that's called cash boot. And if you do get that cash boot, you're just going to have to pay taxes on that gain. But there's actually a way to avoid having cash boot, and John's going to explain that later when he's on.
Chris,
The next,
I'm sorry. I received a question here, and I'm not sure if this is the best time or later, but they're saying, I've held my property for 1 year and plan to sell it in the next 2. How does this time frame impact my eligibility with the 1031 exchange?
Okay, so they've owned the property for 1 year and they plan to sell it in
Sell
2
it within,
years.
yeah, in 2 years, yeah.
Okay, and then so they're gonna have the property for at least
For
3 years.
3 years, basically, yeah.
Right. Okay, so that, I mean, if it's a rental and you've declared it on your taxes on your Schedule E as an investment property, you have leases and you have all the leases, hard copies of all the leases are on your computer to prove that it was a rental property. You should be okay as long as you've held it as an investment property and your intent was to hold it as an investment property. When you sell it, your intent has to be to purchase another investment property, right? Because in the code, it indicates you have to have held that property for the productive use of a trade or business or held it for investment purposes. When you sell that investment property, you can't buy another property with the intent to live in it. You have to buy another rental property. So if you've owned it for 3 years, you're good.
Great.
I hope that answers your question.
I hope that answers your question.
Yeah, if not, then just give us a, give us a
Yeah,
question on the chat. I'll
just
be
shout
happy to
out.
address it. But yeah, if you've held it for at least 2 years or more, you're good. The third one is the same taxpayer selling must be the same taxpayer buying. And in the eyes of the IRS, we are known by our EIN number and our social security number. So there has to be consistency when you're selling and when you're purchasing property. As long as it's John and Mary Smith as husband and wife selling the property and John and Mary Smith as husband and wife purchasing the next property, right? Or John and Smith family trust selling the property and John and Mary Smith, family trust buying the next property, there's consistency there. The problems that we run into is when there's an LLC and many investors own properties in an LLC and you have 4 investors, 2 of them want to do a 1031 exchange and 2 of them do not want to do a 1031 exchange. So they have to talk to their CPA and somehow deed them out or drop them out of that LLC so that, the other 2 can go ahead and do a 1031 exchange with that LLC in the next property. So it gets a little sticky, but that's when you have to contact the CPA for some advice on how to do that. And then the fourth one is you have to adhere to a strict timeline. It's 180 days to close on your replacement property after you closed on your relinquished property, with the first 45 days allowing the investor to identify up to 3 properties they wish to purchase. As long as they purchase 1, we're good, and equal to or greater in value than what they're selling so that they can be fully tax deferred, we're good. So these are all the rules that you need, and I've given Tiffany a cheat sheet, and anyone who needs it, they can refer to this. It's very simple. Anything over and above these questions, please contact me, because every 1031 exchange has different issues and different nuances. Okay, next slide. So these are all the types of exchanges that we do. We do the simultaneous exchange where the taxpayer completes the sale and purchase all in the same day, and it requires 1 escrow. It's hard to time these things, so this is very rare that we do these simultaneous exchanges, but you still have to involve a qualified intermediary to facilitate that exchange. The most common one is obviously the delayed exchange. It's also called the Starker exchange or a forward exchange. That starts out at $1,250. The simultaneous exchange is also $1,250. And that includes the sale of 1 property, your relinquished property, and the purchase of 1 replacement property. Each additional leg or each additional property you wish to purchase is $350. So if you sell 1 property and buy 3, it's $1,950. And again, 180 days to close, with the first 45 days allowing the investor to identify the property or properties they wish to purchase. One of the things that we have that we've seen an increase on is the reverse exchange. Many investors, one of the things that they're afraid of is they're not going to be able to find the replacement property within the first 45 days, because that goes just like that. It's so quick. So they're afraid that they're giving up a good property and settling for something that they really don't want, or that's not up to their standards. So with the reverse exchange, if not opportunity is knocking on their door and they fall in love with a property, let's say they're in Arizona and they run into this 8-unit apartment complex that's for sale and they absolutely love it. Well, with the reverse exchange, you can actually write an offer on that apartment building and close on that property and then sell your relinquished property. How that works, though, is that the investor cannot be entitled to both the replacement property, the apartment building, and the relinquished property at the same time, because he can't exchange to himself, and the code, the IRS code, does not allow for that to happen. So what we have to do is that replacement property, that apartment building, has to be dropped into what's called an exchange accommodator title holder. It's also which we form a corporation for that EAT, that exchange accommodator title holder. And what it does, it takes title off of that investor from that replacement property completely out. That way, they're not on title to that property. And now they can sell their relinquished property. Once that relinquished property closes, then they can go ahead and repurchase that replacement property under that corporation, and it all has to be done within 180 days. That starts out at $8,000. It involves an attorney. And so for many investors who want the peace of mind, knowing that they want to get the property that they want, that meets their goals or meets their objectives and meets their criteria, a reverse exchange is good for them. And this is for the seasoned investors who have properties who are valued at over $2 million. Built to suits for an investor who sees an opportunity where they want to do major construction on a fixer upper. Let's say they're selling for $2 million, right? Their exchange funds are $2 million. They use the $1 million to buy that apartment complex. And then they use that other $1 million to go ahead and do the fix up. Exchange Resources facilitates that exchange. And as long as the major construction is done within that 180 days, we can do that for them. So, but the reverse exchange and build to suit, very complex. So if that's something that you definitely want to do, please let us know. The build to suit starts out at $9,000. Okay, so these are all the exchange types that we do. We don't have our hand in anything else. We just focus in on being experts at 1031 tax deferred exchanges. All right, next slide. And that is the basics of 1031 exchanges.
Awesome. Thank you so much, Chris. That was
You're welcome.
amazing. I
Chris,
know that's a lot of
yeah,
go ahead.
sorry, Tiffany, at what point in time should anyone here contact you if they have a property? At what point in time during their holding of that property should they start contacting you to talk about some of their options?
They can contact, well, my contact information is available for you. So at any point in time, we can schedule a conference call with a consultant, and then that way we can answer all their questions. I normally have the consultation with one of my administrators, so that way we can answer all their questions. They feel comfortable about the process, and they know what their options are when it comes to 1031 exchange. And we can kind of determine whether or not they actually qualify for a 1031 exchange. We have what's called a hit list. There's 3 questions. Has it been held for an investment property? Do you intend to hold it as an investment property? What was the intent? Did you intend to hold the relinquished property as an investment? Do you intend to purchase an investment property and hold it for a period of time where you get cash flow? And then the third one is taxpayers. Are both taxpayers the same? Is it consistent? So that's one of the questions. Those are the 3 questions that we ask to determine if they're qualified. But yeah, they can call us anytime. That way we can answer all their questions, and that way they don't have a huge tax consequence.
Absolutely. And if you weren't able to get Chris's QR code in the chat, you can find his information, phone number, email.
All right. So I'd like to introduce John Grady. John Grady has been in the industry. He's been a financial advisor for over 20 years. He graduated from Western New England University with a bachelor's degree in finance. He holds a Series 7, 63, and a 65 securities registrations. So he's an expert at Delaware statutory trusts. And John, take it away.
Outstanding. Thank you, Chris. Great
You're
job
welcome.
as always. Tiffany, Carla, thank you so much for the opportunity to speak with everybody today. I personally feel that the 1031 code is the largest and best creator of generational wealth that's ever existed. Because if you think about everything that Chris just said, you know, you're able to take what arguably is the largest asset or assets that somebody will own in their family, which is their real estate, watch it appreciate over a number of years. And in lieu of paying taxes, you get to just buy another piece of real estate with all of the growth. And you can continue to do that as many times as you want until you pass. And ultimately, when you do pass with real estate, the IRS gives you that full step up in basis for tax purposes, so that all of those assets get passed on to your heirs. And you can see that you can quickly change the trajectory of family wealth really quickly with just a few properties. So great job, Chris. So My name is John Grady. I am a financial advisor, a wealth advisor here locally in San Diego. Our office is in Scripps Ranch. I'm from Massachusetts originally. Please don't hold it against me. But I did get my start out there with John Hancock, and they moved me out to San Diego. And I've worked with a few firms at that time over those years. Most recently, I was with Cantor Fitzgerald. That name might ring a bell recently because 9/11 just came and went. And Cantor Fitzgerald was in the top 5 floors of the World Trade Center. So that name might be ringing a bell for that reason. But Cantor Fitzgerald is the largest private investment bank on Wall Street. They're a prolific real estate syndicator, and they lend on a lot of real estate and build REITs, build DSTs, build opportunity zone funds. And I was fortunate to be a part of that firm for the last 8 years. A few years back, I decided to create my own firm because I saw there was a big void in the financial services space. And that void was, as I was meeting with financial advisors daily, I probably met with thousands of financial advisors to teach them how different real estate programs can work. I saw that financial advisors are really, really good at managing a portfolio of IRA, 401k assets, brokerage accounts, stocks and bonds, but there was this void when it came to real estate, and I thought that that void needed to be filled. So I created my own firm, Grady Capital Group, and we help clients specifically work through their real estate, whether that be their primary residence, but moreover, we're working with clients that have built a portfolio, whether it's large or small, of investment property. And that could be something as simple as their starter home that they purchased when they first, got big boy, big girl money. And then maybe they've just continued to create a portfolio of wealth along the way by building different, by owning different pieces of real estate. Ultimately, what we find, and specifically here in San Diego, is that real estate has appreciated so rapidly that it's become nearly impossible to keep up your rents. So what ultimately happens is you end up having a disproportionate amount of equity tied up inside of real estate, which is inherently illiquid. So we like to let people know what their return actually is if the equity that's in that property is being utilized to the highest and best use. And if there are other options out there, we'd like to explore them. And all too often, a Delaware statutory trust does come up, as it should, as an alternative to what they're already used to. So what is a Delaware statutory trust? Thank you for moving that slide. So a Delaware statutory trust is just that. It's a trust that's formed in Delaware, which is a business-friendly state, and it's a grantor trust. The statutory part of the trust means that it's built specifically for a purpose, and that purpose is it's built to own real estate to receive 1031 exchange proceeds from investors. So typically, in a scenario that Chris outlined before, you own a piece of real estate for a number of years, it's appreciated, you want to sell it, and typically you're going to look for another piece of real estate, maybe locally in your neighborhood or maybe in another state that you might want to find a nice investment in. A Delaware statutory trust is going to be a much larger investment, most likely. Can you clip forward to Tiffany? So typically inside of a Delaware statutory trust, one more, you're going to see larger institutional assets. So these assets could be 200 to 400 unit multifamily apartment complexes, could be senior housing communities, they could be self-storage facilities, student housing outside of major campuses, Power 5 universities, distribution centers, industrial, and of course, life sciences. These are all typically what you'll see inside of a Delaware statutory trust. And why would they choose these types of assets? Well, they're institutional in quality. So when you exchange into one of these DSTs, you're going to own a fractional interest of a very, very large asset. So example one would be a 200 unit complex in, say, Dallas, Texas, multifamily, brand new built 2025. They buy it for $100 million, they being the sponsor. They put a $50 million piece of debt on it. So they have $5 million worth of equity that's available for exchangers to exchange into. So if Chris had $1 million to exchange and Tiffany had 500 and Carla had 750, everybody would be exchanging over their proceeds into this trust and they would now own a fractional interest of that asset that's inside of the trust. Okay. The benefit of that is obviously it's an institutional piece of real estate, much bigger than you probably had here locally in San Diego or wherever you may be in the United States. So it's professionally managed. They have multiple apartments, so it could be one unit that you exchange from into 200, so you have the ability to have much more diversification. You could be in a very tax-friendly state now. And of course, and I think this is the reason that most people look at 1031s into DSTs, is you do not have to worry about the day-to-day management of the property. Right? You are truly a passive investor in this investment now. So it's professionally managed. You get a check every single month, and then you simply sit back and wait for the sponsor to manage the property duly until it's ultimately sold at some point in the future, which is typically 5 to 7 years. Tiffany, can you go back one slide? Thank you. So the structure of the DST is built in a way that primarily it's for investors. Back one more, please. So they're built primarily for investors that do not want to deal with the day-to-day management. And I know firsthand when I sit down with a lot of our clients, as we're talking about financial planning and we're talking about retirement, one of the things that comes up frequently is I'm just tired of being a landlord. I'm tired of that phone call from my client in the middle of the night. I'm tired of the water heater breaking. I've got a lot of deferred maintenance. There's just so much to deal with. Is there another opportunity to own real estate without having to deal with that? And that's exactly why DSTs have become so popular. 10,000 baby boomers are retiring every single day, and that's one of the things that they don't want to have to deal with anymore, right? When you're younger, you don't mind turning the wrench, right, or replacing the toilet, but when you're 65 and older, it does get a little bit more onerous and difficult to do. So that is a primary reason why somebody might want to exchange into a DST. The diversification aspect. I mean, I can't stress this enough. When we work with a client down here in San Diego that might have a condo, and that condo, their tenant leaves, they may be vacant for a month or 2 months or 3 months, right? So when you have one property with one tenant, the opportunity to go vacant for an extended period of time is pretty strong. When you go into an asset that has 200 units or 300 units, there's people moving in and out of every single month, but the chances of you being 0% occupied are quite slim. Typically, these will run at an occupancy of anywhere between 90 to 95. And the good rule of thumb is once you've hit 95% occupancy, you need to start charging more in rent. That's just a rule of thumb. Right. So going into a little bit more diversification, not only that, but you get diversification across different sectors. So it might be a property in Mission Bay that you sold, and now you own an apartment complex in Dallas and a distribution center in Kentucky. So you've truly diversified your real estate position, and you're getting access to those institutional quality pieces of real estate with potentially $500,000, $1 million, even as low as $100,000 will get you into these types of properties. I mentioned in my example that some of these DSTs carry debt. So going back to what Chris mentioned before, in the process of 1031 exchange, you have to buy equal or greater in value. And that means you need to sometimes replace debt. So in an example, like he was saying, if you sold a property for $2 million and you had a $500,000 loan on there, at closing, that loan gets paid off. You'll have $1.5 million worth of equity at closing to buy a new property. But if you recall, you have to buy $2 million or more of new property. So your options are two: either bring in a $500,000 of money on the side to get you to 2 million, or you can go and get a loan. For some people, they just don't want to get a loan. Maybe they're retired now. Maybe they don't have the income to show anymore where they can't get a good loan. And honestly, a lot of people have these golden handcuffs where they got a loan in 2020 around 3% or lower. And now the new loan that they can get is in the sixes. So it simply just doesn't pencil out to be a good investment anymore because of the cost of the debt. Why DSTs can be helpful is that these DSTs come pre-populated with different levels of debt for the investor. So if an investor is looking for 30% leverage, we can find a DST that already has secured a loan that'll give them that 30% leverage that they're looking for. And what's unique is if you think about the company that I used to work for, which was Cantor Fitzgerald, that was an investment grade firm. So they had an investment grade balance sheet. So when they would go to the agencies for a loan, they would typically see much better terms than you or I would all be able to get. In fact, I just looked at a DST from them recently and it was in the low fives. I think it was 5.1 fixed for 10 years. So when you're able to get that type of financing, it helps your entry level versus your cap rate when you're buying a property, and it makes it work a little bit better. Right. What's also nice about that debt is it's non-recourse to you. You're not on the loan. You don't have to qualify for the loan. There's never a capital call on that loan. It's simply, from the IRS's standpoint, the revenue ruling that came through in 2004 said that the debt at the DST is treated as your debt for 1031 replacement purposes.
John, I think this is going to be a good time for a pop quiz. What do you think?
Yeah, pop quiz. Let's do it.
Awesome. All right, let me go ahead and do the second question. Which of the following does not qualify for a 1031 exchange choice? So if you were paying attention to Chris's presentation, but right after this, I think that the last question would actually be a good one to pop up too for DST.
Yep.
We can jump right into that if you'd like.
All right. Oops. Sorry, I accidentally ended it before the others can throw in their votes here. So yeah, John, if you want to kind of share a little bit about what the correct answer would be.
Sure, absolutely. So the correct answer is you cannot 1031 exchange into REIT shares. We got 2 out of 3 correct here. So REIT shares are considered an equity position, right? So it's not considered like-kind property. Vacant land, Delaware statutory trust, commercial property, all are. There is a caveat to this. You can work your way up to REIT shares, but it's a little bit more time intensive, and you have to do section 1031 first and then a 721. So section 1031 and section 721 are 2 different sections of the code, but if you utilize them together, which we have done and do, you can ultimately work your way into REIT shares. But the traditional 1031 does not allow you to go from rental property into REIT shares.
Perfect. Thank you for sharing that.
Thanks,
And I'm
John.
gonna go ahead and pop up the quiz, the last one. And this is true or false. You can use a DST as a backup option if you can't identify replacement property within 45 days. Prima, I saw you screwing your brow like thinking hard. All right. I'm gonna go ahead and end the poll for now.
Yeah, well, the answer is yes. So true. Yes, DSTs do make great backup properties and great options. So if you recall, Chris mentioned that in the 1031 exchange process, you get to identify properties that you want to exchange into. And you have 45 days to identify such properties. So a lot of things can happen in 45 days. And we know that 45 days is all encompassing of weekends and holidays. You don't get any days off. And 45 days comes real quick. So you may have 2 properties lined up that you like locally. And then as you work through the process, you realize, oh, these aren't going to close. One has a slab crack, the other one, the seller's getting a little bit squirrely, and you're not confident that you're going to be able to close on one or both of those properties. What you can do is you can take a DST that fits your needs and goals, and you can use one of the identification lines, and you can identify that DST. What's unique about DSTs as well is if you work with a good wealth advisor and a DST specialist like myself, we can call these DST sponsors and we can say with specifics that I have a client that needs $350,000 of equity in your DST, and this is going to be a backup for a property that they're hoping to buy. and they're going to close on this property potentially in 2 weeks. Essentially, we can guarantee, well, not guarantee, don't want to use the word guarantee, but we can certainly have a high degree of confidence that that DST equity will be available for that client if the first 2 properties should fall out. So you certainly want to do this identification prior to the 45th day, because remember, at midnight on the 45th day, we all turn into pumpkins. You don't get to change that identification on the identification form anymore at that point. So you're stuck with what you've identified. So that's why you get to use the closing with confidence, or to use DSTs as an insurance policy, as I like to put it, makes you feel a little bit more confident going into your exchange through the whole exchange process. It's like we have a
All right,
hand raised
Michael.
from Michael.
Go ahead and unmute yourself. You have a question?
Yeah, so if you put it in that Delaware trust, how easy is it to pull it back out? Is it operate the same as you have to leave it in there for the time frame that you do with an investment property, or is it that's just a safety net while you figure it out and then you can pull it out at any time towards another asset?
Yeah, that's a terrific question, one that I was just about to get to. So Delaware statutory trust. So everything that we just talked about, all those great things that we just talked about, you do have to give to get all of that. And what you're giving up is you are giving up control, because you are truly a passive investor inside of this vehicle. The sponsor that brings any one of these DSTs to market is the one that's going to be making the decisions for all of the investors. That's one of the main differentials between a tenant in common structure, a TIC structure, and a DST. And because of that passive structure, you are along for the ride on that DST until it does sell. So there is no option in year 2 or year 3, Michael, to raise your hand and say, hey, can I get my proceeds out? I found another option here locally. I'd like to use those proceeds. You effectively are in for as long as that particular DST is in operation. So the next logical question will be, well, how long is that traditionally, right? So I typically will say they range between 5 to 7 years. Sometimes they go longer, and sometimes they do go shorter. And you know, in 2000, when we were putting 2020, excuse me, when we were putting clients in DSTs, we told them that, hey, this is traditionally a 5 to 7 year hold. But because the market was so hot, we were actually calling a lot of these investors after year 2 and 3 and saying, yeah, we sold the property. Sorry, I know we told you 5 to 7 years. But 2 to 3 years, and you need to find another 1031 exchange, and hopefully, you know, Chris can be your accommodator again in that particular example. So I hope that answers your question, Michael. Typically, they're 5 to 7 years. There is no liquidity along the way. You simply sit back and get income while you wait, and those checks do come monthly.
All right.
Thank you.
Emma, go ahead and unmute yourself.
Hi. Okay, so there's no minimum needed
So
for the
so
DST?
DSTs have I mean, here's my minimum, right? And the reason I say minimum is most of them will say via the prospectus that they'll have a minimum of $100,000. But the reason that I give you air quotes on that is because a lot of the times we'll see people that will have boot, right? They'll buy a property, maybe they have $500,000 that they have to buy a new property, but they find a property for let's say $490,000 or $60,000. And they don't want to overpay for the property just because they have to use all of those proceeds. So if you do have boot, which is under 100,000, a lot of sponsors will be accommodating and take those proceeds, so you don't have to pay tax on that boot that's left over. So if you end up having $50,000, $60,000 in boot remaining, most sponsors will take that for you, so you don't get hit with that tax on that.
Yeah.
Awesome. I do have a question. This one's going to be for Chris here. What are some of the common mistakes that cause an exchange to fail the IRS requirements?
Yeah, so that's a good question. And some of the most common mistakes is that they fail to, number one, talk to their tax advisor. That's the number one thing that we always recommend, is talk to your tax advisor to make sure that the 1031 exchange is actually beneficial for you, okay? Another common mistake is that within that 45 days, after they sold their relinquished property, they were not able to find anything, or they didn't prepare for it, and they didn't start looking as soon as their property listed. Actually, even before you list your property, you should actually start looking at the properties that you don't want, so that you're able to narrow down the properties that are promising. So that 45-day window is very quick. And a lot of times what they need to do is work with their agent to make sure that they get, additional time. And what I mean by that is some agents, when they list the property, they indicate on the listing that the buyers must agree to accommodate the seller because they're doing a 1031 tax deferred exchange. It has to be disclosed. But during the process, you can actually ask your agent to negotiate more time if within that 45-day period, if they haven't identified a property within that 30 days, that they're able to actually increase the escrow period an additional 15 to 30 days so that they have more time to purchase properties. So that time frame really is very quick, and there's ways of getting around that where you can actually get more time so that you don't have that tax consequence. So talking to your CPA, preparing, making sure that you start looking at listings before it's listed, and then making sure that your agent is able to increase that time frame for you in case you're not able to identify a property within that 30 days, that they can actually increase escrow period an additional 15 to 30 days. So those are the most common mistakes. And obviously you don't want to fail, because that's 30 to 40% in taxes that they're going to be subject to if it does fail.
Wonderful. Thank you so much, Chris, for that answer.
You're
And
welcome.
we got a couple more questions, and then we're gonna wrap up. But Michael, go ahead and unmute yourself.
Yeah, if you weren't prepared and you were in the process of selling, would you be able to defer some of that if you offered seller financing to some of these people that are looking at buying it? Would that be able to push off some of that because you're not getting the full capital at once? Or is it once you're getting hit with it, you might as well just take the whole hit and
I'm
come
sorry.
out
Can
with
you rephrase that question, Michael? it was a little confusing. Sorry.
So if you're selling your property and but you didn't really prepare yourself for the next property uh, to roll it over to, would you have the option to be able to maybe offer in that selling of being a seller finance or a buyer finance,
I
financing
see.
the buyer to at least to a certain extent to slow down the amount of capital that you're receiving?
I see what you're saying. That's a very good question. And Michael, are you
Yeah,
on right
yeah,
now? Can you go ahead and interject with regard to that? Because that gets a little complicated, and
yeah.
I'd like maybe your feedback on that.
Michael, that's a good question. So we do see seller carrybacks quite a bit in our industry, and seller carrybacks in 1031, whether you're dealing with the down leg or the relinquished property or the up leg, also known as the replacement property, it's fine in a 1031 exchange, but there's some caveats when our taxpayer is actually doing the seller carryback. They're acting as maybe the lender partially for their buyer. The IRS has essentially ruled that those funds essentially become a note, and therefore they're a security instrument. They're no longer exchangeable at that point. What we always kind of warn people about doing that up front is essentially the IRS requires the taxpayer, to replace the full value of that note before the replacement property closes. So they have to come in with essentially new cash to cover that. They can do that by selling the note off to maybe another servicing company, or if they have the actual cash on hand, they can do that. And we have to know up front, because we essentially have to exclude the note value from the exchange in our documents. Otherwise, we sign ourselves 100% into the transaction with them so that they can defer the taxes 100%. So I know that's kind of a long answer, but Chris is right. Seller carrybacks do get tricky, but we do them all the time.
Thank you, Michael.
All right, Prima, last question.
Okay. Um, As far as the number of entities that could be a part of the DST, is there a limit?
The number of entities?
Say like if you have 35 people with that can invest in a property as LPs, is there a limit like that on DSTs?
No, I mean, some of these DSTs can be hundreds of millions in dollars in size, so that you're not going to have those types of limitations.
Okay, so say if a property, 200 or 300 door property, all the investors involved in that, they all can move into a trust, a DST. They all can move their funds into the DST if it's available.
Yeah, and anybody who's going through a 1031 exchange, if there's equity available at that DST, they can exchange into that DST with those proceeds. Yeah. If I understand your question properly, so it also doesn't matter what title it's held in. So it could be held in an LLC. The LLC comes over and now owns fractional interest of the DST. It could be held in your name, Prima, and your name would now own a fractional interest of the DST. So as long as there's equity available in that property, they will be accepting exchange proceeds.
And this is set up at the sale or as you're selling the property. The DST is set up. Or is this something you're adding to?
The DST is already in existence. So let me walk you through the scenario, Prima.
Fun.
If you said, I'm going to close escrow in 5 days and my 45 days starts after that, you have essentially what we would do is we look at the entire inventory that's in the market right now of DSTs that already exist. And we would look at the one that meets your needs and goals. And then those are the ones we would look to exchange into. There could be potentially new ones coming in 60 days, which would be outside your date, your 45 days, and some that had closed 10 days prior. But you have a finite amount to use to look at based on your window that you're working in.
All right.
Okay, so it's like being able to add to an account and you're servicing the accounts.
Sure, it's one way to look at it.
Okay. Okay, great. Thank you again.
You got it, Prima.
Thank you
All
all.
right, guys. Thank you so much. That concludes our Q&A session. And of course, thank you to our wonderful presenters. You guys have provided us really great nuggets of information to take on. And of course, as you know, 1031 and DST is a really, robust product and tool that can help you have tax deferrals and really save more of what you make. And so this is such a high level overview of what this could be. So again, I would highly encourage you guys to save their contact information and reach out to them individually to ask any questions that you may not have been able to ask today, or if you think about it later and you realize, oh, I should have asked this. So this is where you can definitely connect with either Chris or John. Again, their information is on inside of the chat. But if you want the cheat sheet that Chris has offered, also let me know as well, and I'll email that to you. And of course, I'm going to share this real quick before you guys hop off, because we did say, hey, you stay at the end, you're going to get to do a little drawing. So can you guys see my screen here on the Wheel of Fortune?
Yes,
So
we
I
can
gotta I keep track of all of those that actually engage and provided questions. So we're gonna go ahead and hit the spin and see who's our lucky winner for the $25 gift card.
Let's
Okay,
go.
great.
Woo! Let's go.
Woohoo!
Oh, I don't think Michael Spring actually counts.
Next.
Let's do that again because he's part of the exchange resources. So I put him in there as well. But
You can always give it back to me, Michael, and I can spend it.
Prima, look at that.
Woohoo! All right. Tiffany, if you can give me her email and phone number, like just email it. And Prima, I'm going to go ahead and send it to you via text message this afternoon. And I'm going to need you to confirm that you received it. Okay. But congratulations. Thank you for being a part of this discussion and the webinar. Tiffany, thank you so much for having us. We really do appreciate it. And John, thank you for being here as well, too. And Michael.
Thanks, everybody. Great
and
question.
we'll have a recording, and in case if you have people that missed the call today, they can actually watch it on our YouTube channel. So we'll send that link out as well. But Chris and John, just an FYI, I'll give you the distribution list because there are several folks that couldn't make it because of technical issues or
Okay.
schedule conflict. But they're very interested in wanting to learn more. And so I want to make sure that you get connected with them, okay?
Super.
Great. Thank you so much. I really appreciate it. Great job, Tiffany. Thank you all so much for having us, John, Michael, everyone.
Thank you, Chris. Thank you,
Carla.
John. Take care. Thank you, everyone, for coming.
Thank you. Have a great day.
Bye.
Bye-bye.
Thank you, guys.